All of that said, my next guest says don't follow this herd. He's sticking with value in the banks. And joining me now is David Katz. He's the Chief Investment Officer at Matrix Asset Advisors. David, welcome. You know, it's always easy to say,
nice to be here.
You know, don't follow the crowd. You should zig when they zag. But is this a issue about herd and momentum, or are, let's call them growth investors, onto the secular performance that this whole sector has enjoyed because it simply has a stronger earnings potential? I mean, Microsoft being a case in point.
No, we would look at the last week as a outlier and really look at the action over the last 5 or 6 months. So coming out of recessions, typically value significantly outpaces growth. Since last September, value has done exceptionally well versus growth. We still think we're in the early innings of that. So you're getting a breather now, you're getting a pullback. We think this is going to be the pause that refreshes, and we think on a 6 to 12-month basis that value still has some very good upside opportunities. We think the same trends that were in place 3 months ago, low interest rates, an improving economy, manageable inflation, are still in place. We think ultimately rates will drift higher, but not to the extent that should derail value. And we think one of the things that you mentioned there was financials. Financials had a great run. They've just given back about 3 to 7%, certain of the larger banks. We think that is a great opportunity to get involved now because we think they're going to benefit from a rising rate environment. And you might get some good news in the next day or two out of the Fed in terms of their capitalization.
Sure, but what if rates don't drift higher? I mean, that's been the biggest surprise of the past week, even the past few months. And what does that mean for the financials?
Well, in terms of the financials, they've got so many other things going for them that even if rates stay relatively low, they're still making a great deal of money. An improving economy means ultimately there's going to be more lending, and it also means that their loan portfolio, their bad debt expense, is going to go down significantly. So we think they're in a good place, and we do think that they're going to be allowed to raise their dividends and buy stock back. So when rates rise, that's just going to be the icing on the cake. But we do think you want to put it in perspective. The economy is booming right now. You're going to see better trends in terms of the labor markets come September, October. Taken all together, we think ultimately the Fed is going to be raising rates. What they said last week was that they're probably going to be raising rates sooner than people expected. We think over the next 6 to 12 months, they're probably going to move that date forward a little bit more. It doesn't mean it's going to derail the economy, but it is out there.
Shepard Smith here. Thanks for watching CNBC on YouTube.